mention this, but I've been at Schwab for a little over 20 years, and I've known Tom for that long and his team. So it's always wonderful to partner with a firm that you've known as long as I have and been able to do really great things for our clients. So we're excited to talk about some year-end strategies. It is amazing. It's December, and Tom's right, this is our busiest time of the year. And especially this year, because with the election, there were a lot of clients and advisors who were waiting to see the outcome of the election before they were going to finalize their end of year planning. So if you haven't finished your own planning, you are not alone. You are in good company. And the idea of the time today is to talk about some strategies that you can either implement now before year end, and some things that you can also consider for next year too. So let me share my screen. And I want to talk about now this 3 considerations as it relates to charitable giving. And these are specifically important for this year, 2020. You see in the green circle, continued need. It has been an unprecedented year of need. I feel like I don't even need to say that. We all know what's happened with COVID-19, the social justice issues, as well as the natural disasters that just have barraged us this year and years in the past. So that has always been the case, and this year again, just even more so is the need that's out there. The second consideration for charitable giving are the markets. Many of you are working with Meyer Capital or have other advisors, so you are in conversation with them about your portfolios. And I just want to make a point that it is important to talk to your advisors about the fact that you do give to charity. Because when we have markets that are like this today, in some cases, there might be an opportunity to rebalance your portfolio or trim positions. And if that's the case, instead of incurring capital gains tax, then you might want to consider the assets that you have in your portfolio to use for charitable giving. So that's a really important piece of what's going on today as well. And we're going to talk a little bit more about that. And the third piece is tax rule changes. As I said, the election was definitely something people were keeping an eye on related to tax rule changes. And I would say that even after the election, as we face 2021 and we're thinking about the Senate race, it's still really unclear what is going to happen from a legislation perspective. And so the point I want to make is that even though some things may change going forward, we're unsure of what those are. And so there's a lot of things that we need to consider right now based on some legislation that's happened in the past. And I like to make the point here too, that when you look at these 3 circles, we give because of need and things that we're motivated by. Either that is what we see in the world in our own experiences or what's happening in our own families. But really good tax planning and tax incentives help us give more to the causes we care about most. I want to start with the Tax Cut and Jobs Act, which was implemented in 2017. And I talk about it because it's good level setting for where we are today related to tax incentives and the charitable deduction. So when you make a charitable gift, if you itemize on your tax return, you can deduct up to a certain percentage of your adjusted gross income for your gift. If you give to cash to a public charity, or as Tom mentioned, a donor advised fund, you can deduct up to 60% of your adjusted gross income. If you give appreciated securities that have been held over a year, so think about your stocks or your ETFs or your mutual funds, you can deduct up to 30% of your adjusted gross income. The value of appreciated stocks, though, as I mentioned, is that when you give those to charity, you're not incurring capital gains as if you would when you would sell them. So that was 2017, and that 60% AGI deduction was actually an increase from years past. But now 2020, and we have the CARES Act, and Michael and I were just talking about, you know, the different changes and strategies that advisors and clients are talking about because of the CARES Act. But there are really two things that are related to charitable giving for this year. And the first is that if you are giving to charity and you don't take, if you don't itemize, excuse me, you can still give this $300 above the line contribution so that you can deduct it on your return even if you don't itemize. And I just would say here, $300 doesn't seem a lot, but when we talk to charitable organizations, especially this year, there's such great need, they really would appreciate that gift as well. So if you're going to do that, don't forget to talk to your advisor about putting that on your tax return, and then consider it as well if you aren't itemizing. The second piece, and I'm going to go into this in more detail, and we sort of called this the buzz of 2020, was this opportunity for donors to elect 100% of their adjusted gross income as well. And both of these, as you can see, are cash donations only, and they have to go directly to an operating charity. So it can't go to a donor advised fund, private foundation, et cetera. It's got to go to those organizations, social services, art, schools, et cetera. So I'll talk about this 100% AGI deduction in just a minute. Again, these are the tax incentives that exist today in 2020. And with this, we're going to go into some strategies that you'll want to consider and how that donor advised fund can be helpful in that as well. So let's talk about the first strategy, and that's utilizing your best assets for giving. I talked a little bit about using appreciated assets, and I just want to give an example of why this is important, because so many of our clients are not talking to their advisors about this. They're writing checks, they're using credit cards, and they have these appreciated assets in their portfolio. And so you can see here, it's two examples. I used to, sometimes I talk about this in terms of option one is Jack, option two is Jill, their sister and brother, and they're both being asked by their alumni to make contributions. And so Jack, he's going to say, well, I have this asset that's appreciated from 5,000 to 50,000. Here's my long-term capital gains, and I'm selling it, right? I'm going to sell this stock. I think I'm going to sell the stock, and I'm going to give the organization the cash. But look what happens. Jack has to pay capital gains tax. So in that case, because he's paid that $6,750, he has less of a charitable contribution to give, and therefore less of a tax deduction to take. So you can see his tax savings. Jill, she's talked to her advisors first, and they've said, don't sell, just contribute the appreciated security directly to the charity. You won't incur any capital gains tax, and then you'll have a larger contribution of 50,000. And you can also see then she has a bigger deduction that she can take as well. And this is in the case that she itemizes. So in the second case, she was able to save an additional $8,370 by contributing that appreciated asset. I also like to make the point here that, of course, publicly traded securities and funds are the most that are received by charities, but there's a lot of other assets in our clients' portfolios that I'd just like to bring up, because you might have them and you might not think, oh, I can't use this for charitable giving. But again, anything that is highly appreciated that then can be liquidated is really a great asset to consider for your giving, because if you sold it, you'd incur the capital gains that I mentioned. So just take a look across these. I work with a lot of clients who own their own businesses and their cost basis was zero, or they have restricted company stock that they've had for years and years that finally vest. And then even real estate, second homes or land can be great considerations as well. So let's move on to the second strategy, which is for those of you that are older than 70 and a half. And this is about using your retirement accounts. So you may recall, and many of you have taken advantage, I'm sure, of using your qualified charitable distribution, which allows you to give up to $100,000 directly to operating charities. So again, not a donor advised fund, but those social services organizations. And that's always been an incredible strategy. You don't have to face ordinary income of 37%, and then ultimately it does reduce the value of your IRA.
Steph, excuse me, that's very, very important to talk about the QCD not being able to be put into a DAF. There's sometimes confusion out there, and that is an absolute no-no, correct?
Yes, you are able to take your QCD and give it to an operating charity, but you cannot give your QCD to a donor advised fund. So let's say this year is a very unique year though, because with the CARES Act, you don't need to take your RMD, but you still may want to use your QCD. And the reason why it's important to think about that is because you are charitably inclined, you can still avoid the ordinary income tax rate, and again, it reduces the value of your IRA. But because you don't have to take your RMD this year, there's another really interesting strategy that we're talking a lot about, which is thinking about a Roth conversion and then offsetting that Roth conversion by making a charitable contribution and getting a charitable deduction. And this, Tom, is where the donor advised fund can come in. If you have an IRA and you're over 72 and you don't have to take your RMD this year, then you're not being faced with the tax that you normally would have incurred. So now you can say, well, if I want to convert that or some of that traditional IRA into a Roth, then what that'll do is, if I think about my heirs who are receiving my IRA, it will reduce the tax that they would incur when they received that after I pass. And so again, you're going to face a tax by having the Roth conversion. So in that case, take some assets, contribute them to charity, and claim a charitable deduction if you itemize. And again, this is, as I mentioned, and I'll talk about this in a little bit, when you can consider using the donor advised fund. So let's talk about the third strategy, as I've alluded to in the beginning, and that is related to this charitable deduction. Right? So I mentioned, if you do not itemize in your tax return, you can still give $300 above the line. And then strategy 2 is this 100% election of cash gifts in 2020. And we had a lot of conversation about this within Schwab. Tom and I even talked about this last week about the benefits of taking this 100% AGI election or not. And we ran some calculations, and so I wanted to share some of these with you just to show that in some cases it does make sense to take this 100% election, but some cases it really doesn't. So there's 2 examples here. And again, this money that goes out has to be cash only, and it has to be to an operating charity. So you want to be able to say, I want to give a lot of money to certain organizations this year, and I'm in a specific tax situation that makes this beneficial to me. So if you look at tax 1, you can see here how a client might have an adjusted gross income of $1 million. They can take a charitable deduction and offset that $1 million of AGI. And then in 2021, they still have that same $1 million. They're not giving, and they're taking the standard deduction. So you can see they have no taxable income in 2020, but they'll have taxable income in 2021. They won't have any tax due this year, but next year they will. And so the tax over the 2 years is, you can see, $297,000 plus. The reason why I'll talk about scenario 2, and this has to do with using the default 60% deduction in 2020. You're still giving the same $1 million, but instead of electing that 100% deduction, you're saying, you know what, I'm only going to take my 60% deduction and I'm going to carry forward everything else that I didn't deduct. And I didn't mention, when you are able to deduct a certain percentage against your income, if you can't use everything, there's a 5-year carry forward that you're able to take. So in this case, this client carried forward what he wasn't able to deduct against his income. And in this case, it was $400,000. So you can see as taxable income in both years, but because of the tax brackets and the way the calculations work, you have tax brackets at 37%, 35%, and it drops from there. And as you go through each tax bracket, it wipes out that tax bracket and moves to the next. And so in the scenario 1, they went through all the tax brackets, but in scenario 2, they said, you know what, I'm only going to utilize the 37 and 35% tax bracket. I'm going to carry forward the rest, and I'll use that 37 and 35 the following year. And that is what enables the larger savings in tax somewhat and seem somewhat more complicated, and I will confess I am not a tax advisor or even a retired one. So I would really strongly suggest talking to your advisors about this scenario, what makes sense for you. I now want to talk about one of my favorite strategies, which is bunching, and this is really related to the charitable deduction that's been put into place since the Tax Cut and Jobs Act. Many clients since 2017, their deductions were reduced, and the standard deduction was increased, right? So you can see here that the standard deduction is now $24,800. And you have a client situation where they have deductions at $13,000 each year, and then they make a charitable contribution and a charitable deduction of $10,000. You can see they're taking the standard each year. So what if they bunched that giving and took $10,000 and put $20,000 of 1 year? Well, now you can see in 1 year they can itemize. The following year they have to take the standard, right? Which is again that are not giving, and so the standard is the $25,100. But because they actually itemized in 1 year, they were able to save $8,200 of additional tax deductions over 2 years. So again, if you have the extra capacity to do this, it's something to really consider so that you can then think about using tax incentives to minimize your taxes and ultimately have more to give because you have additional tax deductions. Now, I'll stop here for a second, and if any of you have ever faced this, you'll understand what I'm going to say. In this case, if you think about bunching and that $20,000, you're probably not giving that to one charitable organization. But as we talked about the unprecedented need, maybe it makes sense to give $20,000 to the organizations this year. But in most cases, that's not what donors want to do, and that's not even what charitable organizations want. They prefer that $10,000 in this year and that $10,000 next year. So how would you be able to do that? By getting the tax deduction that you need of $20,000 and then being able to spread your giving over the 2 years that you normally do. Well, this is where the donor advised fund comes in and has been a really great vehicle for the strategy of bunching along with other things. So the donor advised fund, as Tom mentioned, is actually, it's an account. And it's administered by a public charity. So I work for Schwab Charitable. And the reason that having this account administered by a public charity is important is because when you contribute, let's think of our example of the bunching, that $20,000, you get the same deduction as you would by giving to another 501c3 public charity like the social services, museums, etc. You get the tax deduction the day the money is contributed into the account. If it's appreciated assets, it becomes the fair market value of those assets. And then those assets are sold inside Schwab Charitable, the charity, which means no one is incurring the capital gains. So now you have the $20,000 inside your donor advised fund. I'm going to talk about the investment options in just a minute, but then you can give that money to the organization of your choice over time. And in this case of the bunching, it might be $10,000 right away and $10,000 the following year, just like you would normally do. If you also think about all of these charitable organizations that you might be giving to, you're now making one contribution into the donor advised fund, and we keep track of all of the gifts that you give out instead of having a spreadsheet or what I like to call a shoebox of receipts. So I want to share here what it looks like to make a grant, and then we'll talk a little bit about the investment options. And as I move here, and Tom, you had asked me to show what it looks like to make a grant. We actually just changed and enhanced our grant flow, so I'm really excited about this. So the benefit of the donor advised fund, if you have other Schwab accounts, is it's linked to your other Schwab accounts. If you're working with Meyer Capital, they link it as well, so they can see all of your accounts in one place. So you get to search for your charitable organization, and we have a whole database of all of the nonprofits that are registered with the IRS. So that's millions. Once you find your account, the charitable organization that you want to give to, you can decide how much you want to grant, as you can see here. And then you can decide if you want to have this a one-time gift or a reoccurring gift. You can even dedicate the gift to someone, have it be in honor of someone. And then this is the best part. You can actually decide how you want the gift to be used. Do you want it to go for a special purpose, or just generally to the organization for their choice to use it? So we've created lots of drop downs that you can choose from that enable the grant to go out. You can even see here annual gift. You can even see membership, but you're not getting any benefit. So lots of ways to just quickly do a drop down. But in some cases, let's just say you want to do something very, very specific with the organization. You can actually customize a letter that you write in what you want to say to that organization. And that's what this looks like. So when we get your grant request, we will send out a letter that you've customized, as you can see here, and the check that goes out to the organization. You name this account. This one was called the John and Mary Client Test Charitable Fund. And you can be recognized in the way that you want to be recognized here. They were recognized John and Mary. You could change that if you'd like. You can include your address if you want to, or you don't have to. Sometimes I get the question, well, this is great. Why would I want to use a donor advised fund versus giving directly to the charitable organization, even with my appreciated assets? And I'll say, if you think about this, the organization's getting a straight check of $250. So much easier for them to accept that than process appreciated securities. We make that easy as a financial institution to do that. The second thing is, if you think about the gifts you want to give, sometimes maybe it's not just it's a straight dollar amount that you want to give, like $500. Well, it's much harder to say, I want to give $500, and how do I find the appreciated asset that matches that value? And then the other thing is, sometimes there's a better part of the year to be thinking about rebalancing your portfolio and using your assets in the best way versus when you want to give those to the organization. So again, as we talked about, it really separates your tax strategy and your financial objectives with your giving strategy and giving to those organizations that you care about most. So I want to just end here before I turn it over to Michael on what happens with the assets are in the account. We've contributed our $20,000 in appreciated assets. They can be liquidated immediately and then reinvested. We have a choice of mutual funds that the account can be invested in, and your advisors can help you decide what the best makeup of those fund pools are. And I like to make the point that we have some index funds, actively managed funds, and socially responsible funds. We also have an opportunity with a professionally managed account. And this is a $250,000 minimum. The one thing I forgot to mention, which is so exciting, is we just eliminated our minimum to open a donor advised fund at all. It used to be $5,000, and now there's no minimum. But if you want to use the professionally managed account option, it's $250,000. And then if you're working with an advisor like Meyer Capital, they will help you think about the best models of their investments that match, you know, what your overall goals are. So that 20,000 that we talked about of appreciated assets, it could be liquidated in the account and then reinvested. If you think about a concentrated position that you might have that you're concerned about, wow, what happens if I sold this in the capital gains, but I'm concerned it's a risk. Now I can diversify. So now I can contribute that, liquidate it and reinvest. But there's also something that's really exciting when you're working with an advisor, and we've had a lot of clients who are very, very bullish on their tech stocks, take advantage of. If you put a contribution in, let's just say 20,000 of name your tech stock, and you don't want to liquidate it because you're really bullish on it, you can actually keep that contribution in kind in the account and then slowly liquidate it as you want to make grants and over time. So that's been really powerful this year as well for some of our clients who, again, are very excited about their own stock. Before I turn it over to, or the stocks, I should say.
Hey, Steph.
Yeah.
I can't emphasize enough how important the previous slide 15 of how easy to take the pressure off at year end for, you know, individuals that, you know, want to write 5 to 10 to 15 checks at the end of the year. And whereas they can just go right into the DAF fund, get that deduction, take a step back, relax, and then worry about that in January. Yeah, you know, it just takes all the pressure off for sure. Exactly.
I think we all feel obligated and compelled to do our giving in December because that's when we're hearing about it. But actually, when you talk to some charitable organizations, their books don't close until June. And so they're really happy to get grants between January and June. They're spending as much time as they possibly can just trying to get through the holidays, process what they're getting in. They're actually taking a lot of pressure off of them by getting your deduction and the deduction that you need, but actually doing your grant making in the beginning of the year. Thanks for commenting on that.
Sure.
I'm going to turn over to Michael and you in just a minute, but I want to go back here because what you're going to talk about, I know, is so important related to options and investing. And if you think about this donor advised fund, as you're listening to Tom and Michael, this again is an account, and it's an account for charitable purpose, but it's also an investment account. And one of the things that I really appreciate is that you think about what your goals are from a charitable perspective, and then you actually can say, well, how do I align my investments in my donor advised fund with my charitable goals? And that's really now what Tom and Michael are going to talk about. And so I think that's very powerful and another huge benefit of the donor advised fund, which is being able to say, these are my values, these are the causes, and not only do I get to give to those charitable organizations, but I get to align my investments. So again, thank you both so much for your thoughtfulness and